Good morning, traders and titans. Welcome to the ARC Protocol, your daily signal through the noise. The main headline flashing across our data streams this morning: the race for our roads is heating up. Lyft is shifting gears, vowing to flood the streets with autonomous vehicles in a high-stakes bid to outmaneuver Uber. Our primary segment zeroes in on that bombshell report. According to TechCrunch, Lyft's CEO has confirmed an aggressive expansion of its autonomous fleet this year. This isn't just a tech demo, it's a strategic counterattack. The ride-hailing market is notoriously volatile, a shaky digital backdrop for any company, and Uber has long held the lead. By leaning hard into autonomy, Lyft is betting its future on a driverless paradigm. They're not just trying to catch up, they're trying to redefine the race itself. This move could fundamentally alter the economics of transport, but it's a monumental gamble on unproven technology and uncertain regulatory frameworks. We'll be watching the data points closely to see if this is a masterstroke or a critical system error. Now let's pivot to the macro-level code that governs the markets. Data from investing.com reveals that newly released Federal Reserve minutes are sending shockwaves through the system. The sentiment is far more hawkish than the market anticipated, with a strong consensus among members that rate cuts are unlikely before the fourth quarter. The US dollar index immediately surged on the news, applying significant pressure to the equity markets, particularly the high-growth tech sector. This is the Fed making it clear the fight against inflation isn't over, and the era of cheap capital remains on hold. Expect turbulence as algorithms and traders alike recalibrate their forecasts. In the world of digital assets, a significant upgrade is on the horizon. CoinDesk reports that Ethereum developers have successfully deployed the Pectra upgrade on a major testnet. This is a critical step forward, promising to implement a native version of account abstraction. In simple terms, this makes crypto wallets significantly more user-friendly and secure, lowering the barrier to entry for the next wave of users in the decentralized economy. While the market reaction has been muted, the long-term implications for Web3 adoption are immense. And now for the Blitz Round, your rapid-fire intel. Flashing on the wire from CNBC. A new alliance forms to challenge NVIDIA's dominance, as a consortium including Google and Intel announces an open-source framework for AI hardware, aiming to break the market's vendor lock-in. That's the protocol for this morning. The board is lit with conflicting signals. Aggressive technological bets from corporations like Lyft set against a tightening monetary policy from the Fed. The narrative is clear. Innovation is accelerating, but the economic runway is getting shorter. It's 0600 hours on the digital frontier. We lead this morning with the only story that matters: a system-wide information blackout. Our primary data feeds from CoinDesk, CNBC, TechCrunch, and others have gone dark. Instead of market data, we're receiving a single, cryptic packet across all channels. The signal is simple and ominous. Drop true. Let's put that signal on the main screen. For the last hour, our analysis engine has been flagging this identical, corrupted data string. It is an unprecedented data integrity failure. So what is drop true? Our internal analysts at the ARC protocol are working on two primary theories. The first, and most benign, is a catastrophic cascading system failure across the network's primary data vendors, a technical glitch of immense scale. The second theory is more deliberate, that this is a poison pill data packet, a kill switch signal designed to halt algorithmic trading systems that ingest these feeds directly. We are seeing flickers of extreme volatility in pre-market futures, suggesting the market's automated systems are reacting to the data void itself. The market hates a vacuum, and right now we're staring into the abyss. The implications here are cascading. The entire architecture of modern finance runs on the uninterrupted flow of information. We've had a source at investing.com confirm they are seeing the same blackout on their end. They aren't broadcasting, they're investigating. When these primary feeds die, the high-frequency trading algorithms that execute millions of trades per second are effectively flying blind. They either shut down, gutting liquidity from the market, or they begin trading on noise and echoes, which could easily trigger a flash crash. This isn't just a lack of news, it's a direct threat to market stability. This event is a stark reminder of the fragility of our centralized information infrastructure.
We've seen nothing from Decrypt's usually active channels, and their silence further confirms the scope of this outage. The fact that multiple independent and competitive news outlets can be silenced simultaneously points to a critical single point of failure somewhere deep in the web's foundation. We are digging to find out what that is. Is it a cloud provider? A core network protocol? The silence from these media giants is the loudest story in the world right now. Blitz round. Let's recap the board in this information blackout. First, all major financial news feeds are down, replaced by a universal drop command. Second, volatility is spiking as the market's trading algorithms are starved of real-time data. And third, we're tracking a potential single point of failure across the global information network. In an environment with zero visibility, the only strategy is extreme caution. All asset classes are vulnerable until these feeds are restored and the nature of this event is understood. We will stay on this story, broadcasting live as we break through the noise.
Good morning, traders and architects of the new economy. Welcome to the ARC Protocol. Our lead story this morning: a major signal from industry insiders projects 2025 as the definitive turning point for institutional adoption, powered by the twin engines of tokenization and a concept known as agentic commerce. Our top story comes via a key insight reported by CoinDesk. Industry veterans Evan Chang and Stephen McIntosh have put a stake in the ground, declaring 2025 as the year the floodgates truly open for institutional capital. They argue this won't just be about more hedge funds buying digital assets, it's a fundamental operational shift. The core catalysts they identify are first, the widespread tokenization of real-world assets, and second, the emergence of agentic commerce. This isn't an iteration, it's a re-architecture, a signal that the very plumbing of global commerce is set to be rebuilt on-chain. Drilling down on that first pillar, CNBC is highlighting the seismic impact of tokenization. We're talking about the conversion of historically illiquid assets, commercial real estate, fine art, private equity stakes, into divisible, programmable digital tokens. For institutions, this is the holy grail. It unlocks fractional ownership, global liquidity pools, and 24/7 markets for assets that have been locked in analog cages for centuries. This is the bridge that could finally connect the trillions sitting on Wall Street's balance sheets with the efficiency and transparency of decentralized finance. Now for the second, more futuristic pillar: agentic commerce. Our sources at TechCrunch are framing this as the next great convergence of AI and blockchain. Forget simple automated payments. Imagine autonomous AI agents, empowered by smart contracts, executing complex business logic on behalf of corporations. Think of an AI that can manage a global supply chain, autonomously negotiating with suppliers, clearing customs, and settling payments in real time based on 1,000 data inputs. Chang and McIntosh's forecast suggests this science fiction concept is moving rapidly toward reality. Time for the blitz. Here's what else is hitting the wire. From Decrypt, the main takeaway is that the race is now on to build the secure, scalable infrastructure that can support these intelligent agents. And a note from investing.com. Analysts are now suggesting the real alpha in 2025 might not be the assets themselves, but the oracle and compliance protocols that will underpin this new tokenized economy. The message from the inside is loud and clear. The narrative is no longer about if institutions will adopt, but how they will leverage this technology to build a faster, smarter, more automated financial world. 2025 is the year the blueprint becomes the skyscraper. For the market outlook today, expect a surge of interest in projects focused on real-world asset tokenization and decentralized AI infrastructure. Hong Kong just greenlit another player on the digital frontier, signaling its ambition to remain a top-tier financial hub. But is this a market-moving event or just another drop in the data stream? Let's decode the signal. Our lead story comes via investing.com. Hong Kong's Securities and Futures Commission, the SFC, has granted a license to Victory Fintech. Now, on the surface, this is a standard regulatory approval, but the subtext here is critical. The official evaluation, which we've analyzed, calls the move moderately significant, providing legitimacy for Victory to operate within a regulatory framework. This reinforces Hong Kong's position as a city building a robust, compliant ecosystem for financial technology. While analysts caution this is an incremental step rather than a transformative event for the broader market, it's a clear signal. Hong Kong is building its digital asset firewall brick by brick, attracting firms willing to play by the rules. For Victory, it's a license to operate. For the market, it's a sign of maturing regulatory infrastructure in a key global nexus. This isn't happening in a vacuum.
A report from CoinDesk highlights a parallel trend across the region, with regulators actively clarifying the rules of engagement for digital assets. This isn't a clampdown, it's a clarification. Major Asian financial hubs are in a race to define the future of finance, not by stifling innovation, but by creating clear, secure channels for institutional capital to flow. They're telling the world's institutions, we are open for business, but you will operate within our framework. This regional push for regulatory clarity is the dominant narrative right now, impacting everything from institutional adoption to venture capital allocation. And speaking of capital, the money is still moving. TechCrunch reports that a Singapore-based AI-driven wealth management platform just closed a significant Series B funding round. This demonstrates that even as regulators draw sharper lines, smart money is betting big on the tech that will power the next generation of finance in Asia. Investors aren't spooked by regulation, they're encouraged by it. They're backing companies that can navigate the new compliance landscape while delivering sophisticated AI-powered solutions to a growing market. And now for a quick blitz of today's other key datums. CNBC reports, European markets are showing caution ahead of new inflation data expected later this week. A major decentralized finance protocol has just rolled out a key scalability upgrade, promising lower transaction fees. So the key takeaway this morning, Asia is a tale of two forces, methodical regulation and explosive innovation, working in tandem. The old Wild West days are over. The era of the compliant financial architect is here. For the day ahead, keep your terminals tuned to regulatory announcements and their ripple effects across the digital asset space. The market is pricing uncertainty, and any deviation from that path could trigger volatility. I'm your anchor, signing off from the ARC protocol. Stay sharp and trade smart.